All right, so welcome to another video. Today we're going to take a look at Iron Condor strategy on Apple. We're going to get things started. Keep in mind, it's not a recommendation to buy, sell, or trade anything. It's just my own opinion. If you want to grab my opinion, definitely check out our website at tradersfly.com. There's a lot of great stuff here that I have. We go ahead and take a look at the upcoming live classes we have, like market seasons. It's definitely going to be a great class. It's going to run for at least minimum 3 days, maybe 5 days, 9:20 starting time, p.m. Eastern time. So nighttime. It's not live trading market time, so you'll be able to focus and not worry about the markets, or if you're working, you'll be able to handle it. There's a lot of freebies you could get on the website, and definitely check out the Discord channel. It's kind of like a chat room. I post some charts here periodically, absolutely free, and you can also ask questions here. We can chat, and you can ask me specific things in there as well. All right, let's kick things off. Let's go to Apple, and if we go in, and I'm going to do an Iron Condor on Apple. And the reason for that is because if we look at just the VIX has been very high. Now we're pulling back. You might say, hey, well, can I probably do something positive, Vega? Because it'll probably pop again. Yeah, it's possible. It's possible. But overall, you know, the lower end's kind of at 16, and this could keep grinding up to the upside. So you want to be mindful. But, you know, if you want to do something that's let's say shorter duration on Apple, that'll help reduce the Vega exposure. But for me, you know, the VIX is still kind of was at the upper end and it's been climbing down. The trade is going to, as we set this up, you'll see we'll play with the settings, and then you can construct it a little bit differently to offset that VIX and volatility problem. Okay, so here's my thing is when I look at Apple, this stock's been grinding to the upside quite a bit. And if I do an Iron Condor and I position it a little bit more, let's say here and here, kind of right at the middle, this is where volatility can be an issue, is that if this sells off, I've got a problem over here. So what we'll do is actually set it up maybe slightly with some short delta. Okay, so the point of that is that, look, this run has been very positive, and we've got, if we count it, 1, 2, 3, 4, 5, 6, 7, 8, about 8 straight up days. And chances are it's probably going to pull back soon. So this is where we set up the Iron Condor. Even if we set up an Iron Condor just where it can still go a little bit and then pull back, that's what we want to do, is make it kind of work in that way. So I'm going to go ahead and take a look at this and go to Apple here. Now, I already have some trades in here, like a back ratio and so on, and that's working out fine. I'm going to go ahead and actually close that out while I'm here, because this is my paper trading account that I use and work with people on a one-on-one session. So if you do want to get a one-on-one session, just go to tradersfly.com. We can book one-on-one session together, and we can work together. It's through video. Okay, so let's go to the Apple side, and let's go to maybe a 29-day. And what I'm going to do here is I'm going to take a look at the deltas, and probably just looking at the current price, we are at 172. And if I look at the deltas around 20 here and the 20 here, so that's what I'm trying to do, is I'm trying to sell something here and sell something here, assuming the price lands somewhere between the upper range and lower range. So if we sell normally something at the 155, like let's say a put, then I want that stock to go higher because I'm selling under it. On the call side, vice versa, if I sell, let's say, a 190, I want the stock price to stay lower than that. So I'm trying to choose a range, and that's what we'll do. We're going to go ahead. I'm just going to start with selling 2 verticals real quick, and then we'll combine it to an Iron Condor. So here we've got this vertical right here. Okay, so now by setting up this vertical, okay, so I sold the 160s now, and I bought the 155s. That means I need that stock above 160. White line is today, or known as a T+0 line, and green line's at expiration. Chances are we won't get to expiration, but it's there as a setup. So if we goes to 160 or below here, I could get a chance of a sign, so be careful of that. But if it keeps going there, I could sell out of it earlier, or in other words, buy it back beforehand. So I've got this one side set up, but I could also set up the other side. So this way, I'm collecting a little bit of premium from this. How much am I collecting? I'm collecting 53 cents, or in other words, $53, because options are in times 100. 100 contracts is what it or 100 shares is what it controls. So we can go ahead and collect $53, which you could see right there. Okay, so if I move my mouse over there, you can see I collect $53. Okay. And I'm risking about 447. So, maybe about 10% or so. Now I could sell also the other side of this. And let's say we sell maybe the one, in this case, 185 and buy the 190. So I could collect 43 cents on that one. So together, I'm basically looking to collect about $96, right? Between these two. The 96 is right here. That's at expiration. And with time, every day, the stock kind of stands still in between these ranges. I make about $2.49. Okay. So my delta is fairly neutral, which means if the stock kind of wiggles around, I don't make or lose money from price movement. Okay. Now, this is kind of one way to start it out and get it going, but I could do this as a full construction. I got two verticals. I could do it as a full single Iron Condor strategy. So I could go, let's say here, the 160 and 155 and sell like 185 and this one. And there we go. We've got kind of our Iron Condor strategy, and it's usually a better fill rate than something I could get and vertical and a vertical. Okay, so how would I now set this up when the market's a little toppy or the stock's a little toppy? So the issue is that this could pull back. I mean, we've already had, 1 day, 2 day, 3 day, we had 8+ up days. Chances are it's going to go down sometime soon, at least for a couple days. And we're just trying to collect some theta. So if it goes up a little bit, I'm okay with that. And then it'll pull back. But the issue is, if it starts pulling back tomorrow, I'm already in a little bit of trouble here. And this could keep going down a bit. So then I'd have some negative issues. So how would I counteract this? Well, I'd bring this side in a little closer. And that's one way of doing it. I could also offset this and unbalance it, but I think the easiest approach is bringing it in closer. Now, first thing I'm going to do is just bump it up to 10 contracts for now. It's just easier to manipulate it for me. And especially if we start manipulating 1 or 2 contracts here or there, you'll see in a second. So I'm going to bring this in now from 185 to 180. Okay, and then 185. And now I've got some negative delta. And the reason I do this is because you can see with Apple, there's just not a lot of strikes over there. There's a handful, but then there's not a lot of premium after that. So that's why I brought it in. Now we've got about a negative 48 delta. So it's basically getting negative 48 shares. But I've got a positive theta, and I've got a short Vega. So with that short Vega, actually it's offset. Short Vega means short delta. It's actually almost evened out or balanced. Now I could tweak this a little bit if I like. And the way I would do this, I'll change it to custom. And let's say I don't want to be that many shares delta short. Maybe I believe in the stock quite a bit. And if I believe in the stock, I could sell less puts, and I could go in and just say, okay, well, I'll do 9 over here. And now I've got not 9 puts. I'll do 11 puts. I could do 11 puts over here. Okay, and that'll help pick up some speed. But I could also do like 9 on the call side to reduce that upper end, right? So now I've got only 31 deltas if you look at it that way. And I could keep doing this, constructing my Greeks in a little bit of a different fashion. So going from 9, I could also go to 8 right here. Switch that to about 8, and now I've got a only 21 delta short. So that way I'm not too short. If this thing does keep grinding up, I'm not in as nasty or bad of a situation or position. So I'm basically going 11 to 8, and you can keep going like 7 and 7, and now I've got like negative 8 delta. So it's a very small delta negative relative to the short Vega that we have. If you want to be slightly protected for the downside, I'd probably pick it up a little bit more in the sense of maybe like an 8 to 11 or something like that. So now if this pulls back to about 168, you're still kind of okay. And now 168 would be just right down here, and then you're still fine, right? So you're just saying, hey, in the next few days it might pull back a bit, and then again it hangs around and so on, and we're kind of playing around in that range. So that's what we're looking for. And every day that stock stands still, I'm making about $28 a day. And if I move this date figure forward, what you'll be able to see is this profit and loss start to increase and pick up speed. So take a look at this. So watch what happens here. And this white line will actually also move to the upside. So as I move the date forward, you can see right here, 1 day forward will make it about 30 days profitable. And there it is, the theta of 30. Okay, then the next day, it'll be 60. So you can see now my white line is moving a little bit higher and higher in profits. And then I can keep doing that and keep moving it kind of forward. And you can see after a few days, I just have to be kind of in this range between 164 and maybe 177. So even if I go too far up or even too far down and make $170, you know, it's not too bad relative to the risk that you have on hand. So that's what you're looking to do, is just allow that trade to kind of ferment, or allow it to crock pot or boil, whatever term you want to use. You're just letting it sit to be able to kind of get some of that theta, and then you're looking to take that theta off, or that trade off. You don't need to let it sit to expiration. Let it decay a bit, and then you pull the trigger to take it off. So this is what I'm looking to do for something like this, is that when you're setting up this trade like this, where a stock has already been going up for quite a while, you want to compensate a little bit with some negative delta, maybe bring in the call side. I could even bring in the call side even more. Like, let's say I was more worried, I could bring it in even tighter like this, but then, you know, what's happening is you don't have as much range on the upside, so be a little more careful in that case. The other alternative that you could do is you could increase the range on the put side, and let's just say we go this way, and now I get a little bit more of that negative delta back. It gives me more range. Unfortunately, it does use a little more capital, because now you've increased your probability or chance of success. So you've done something like that as well for the downside, to be able to kind of say, hey, I've got a little more range there in case that stock does pull back. So you know, we're kind of, you're not really bearish on it. You know, some people say, are you bearish? No, I've got a lot of short Vega here because it offsets it with the short delta I have. So it's not bearish, it's not bullish. It's actually a little bit more neutral, because the stock's already grinded up a bit. You could say it's much more neutral because we've just been going up for so long. And we're looking to construct a position like this with a lot of short Vega, and the short Vega is the biggest Greek. So if this keeps going to the upside, remember the short Vega, and if I go to, let's say, negative 3, let's go here, negative 3 volatility points, it's going to go ahead and give me quite a bit of bump in my profits there as well. So negative 3, or let's just say 3 times 70. So that's 210 or so, and there's your profit of 210, right? So you take the Vega, if we reduce volatility by 3 times 7, that's 210. So there's your profit and loss there for about $210. That should be there. So anyway, because it's 64, then 65 Vega, and so on and so forth. So anyway, that's how you might do a trade construction like this with a stock that's kind of at the upper end. Maybe you'll have a pullback in the next few days, and you compensate a little bit with some extra short delta for that possible downside move to help offset some of that Vega risk and in some downside thing, or if it just starts going sideways a bit from grinding up so quickly. So anyway, thanks for joining me. Hope you enjoyed this video. Definitely check out the market seasons class that we're going to have going on here very soon, and subscribe to the Traders Fly channel there. And that way you can hop in on a Zoom class session that we'll have. Usually sessions are about 90 minutes or so, and run for 3 to 5 days across that week. So it starts on, if we take a look on the date, April 25th, about 9:20 p.m. Eastern time, nighttime, and get a lot of learning in there as well for different strategies to use in different market conditions. Anyways, thanks again for joining me. Enjoy the rest of the week ahead. I will see you in the next video episode, or maybe in a one-on-one coaching session. Thanks, and take care.